All right, settle in, grab a cold one, because we're about to have a chat that your rich uncle probably wishes he had with you. You know, the one about how to actually get rich, not just how to keep your head above water, everyone. And I mean, everyone tells you when you're young to take risks, right? They say, oh, you've got your whole life ahead of you. If it doesn't work out, you'll be fine. But then, crickets. They never tell you how to actually do it, how to really put your money where your mouth is and swing for the fences. Well, guess what? Your favorite 25-year-old financial rebel is here to spill the beans. And trust me, it's going to be a wild ride. Let's kick this off with mindset, because honestly, that is where most people screw up. You're young, you've got decades, literally decades, to recover if you stumble. So why on earth are you playing it safe? Why are you tiptoeing around like a cat on a hot tin roof? This isn't the time for safety nets, my friend. This is the time for taking as much ball to the wall risk as humanly possible. And yes, I hear you. Calculated risk. Of course, we're not just throwing darts at a board, we want smart risks. But the operative word here is risk, not safety. You don't want to lose everything, obviously, but you absolutely positively do not need to worry about being safe. Safety is for grandmas. No offense to grandmas, you need to embrace volatility. Welcome it with open arms like a long-lost lover. You need to take ferocious, I mean absolutely ferocious, amounts of risks. And for the love of all that is wholly completely forget about bonds. I know. Every financial guru, every boring textbook, every stuffy talking head will tell you to diversify, to invest in low-cost index funds, and to be a boglehead. And listen, I like telling people to just blindly invest in a low-cost index fund, sometimes. But that, my dear friends, is not the path we're taking today. Not in this video. We're not here to be like everyone else. We're not here to just get market returns. We're here to go straight to the moon. And yeah, I know, it sounds like something a Redditor would scream in a frenzy. But guess what? We're shooting for the stars here. We're aiming for life, changing wealth, not just a slightly less depressing retirement. So now that we've got our rebellious skies, the limit mindset firmly in place, and our methodology is basically go big or go home, what exactly are we investing in? Well, before I dive into the good stuff, let me just throw out the usual disclaimer. This is not investment advice. It is not financial advice. It is never financial advice. I'm just some random 20-something with a microphone and some opinions. So please, for your own sake, do your own due diligence. But with that out of the way, we're investing in stocks, plain and simple. Why stocks? Because they are the most efficient, period. End of story. They're highly liquid, meaning you can buy and sell them faster than you can say crypto crash. They're incredibly volatile, which, as I was explaining earlier, is exactly what we want. We're young, we thrive on volatility. It is our playground. And all you need is a phone or a computer. You don't have to deal with the headaches of real estate, the leaky pipes, the annoying tenants, the endless paperwork. You don't have to physically go somewhere and buy something, meet someone in person to resell it. You don't have to deal with people at all, for the most part. And let's be honest, avoiding people is a major win in my book. We are absolutely, unequivocally not taking the classic low-cost index fund, boglehead approach. If you want to get rich, truly rich, you have to concentrate your portfolio. This isn't some fringe idea, folks. Even the legends, Charlie Munger and Warren Buffett, have famously said there have been times when they've had 75%, 100%, sometimes even over 100% of their portfolio allocated to one single thing. Think about that. I know easier said than done finding that one thing, but all you really have to do, and I mean truly all you have to do, is find 1 to 3 high-quality companies that you genuinely... And not only is this the most efficient way to invest in your 20s, it is the way you can absolutely, positively outperform the market. Because at the end of the day, what is the market? It is literally just a basket of stocks, a collection of companies. And if you want to go the index fund route, fine, but at least use leveraged funds now. Again, not financial advice. And yes, no one, absolutely no one, ever says to use those for long-term growth. But you know what? Forget that, bro. If you can make 30% on TQQ versus 10% on QQ, why on earth wouldn't you? I mean, obviously I know if QQQ goes down 10%, then TQQQ is down 30%. But the exact same principle applies, right? You're still getting that amplified movement. So now, not only were you up 30% at one point, which is way, way more than the regular indexes, but now when it dips, it is on sale even harder. A super duper sale. I literally honestly do not understand why anyone, especially someone young, wouldn't do this. Unless maybe you're like 80 years old and about to cash out. Maybe I'm completely insane, but especially when you're younger, like we said, welcome volatility. I genuinely believe you can capitalize on volatility in a way older investors simply cannot. Some of my absolute favorite stocks, the ones that have made me the most money, have really high betas. They swing hard, and that is precisely what we want. But even if you're not quite ready for the leveraged ETF route, maybe you're still a little bit of a scaredy Cat use something like Flex, for example. I just found out about them recently, but holy smokes, they've been outperforming for God knows how long. I literally just ran a quick ChatGPT comparison, pitting the total performance of VU versus QQ versus FSL Flex, which, by the way, was created way back in 1985. It is a semiconductor fund, and get this. If you had invested $10,000 on the inception date of each of these, I believe QQQ would be somewhere around $140,000. The SPVO would be around like $80,000. But if you had invested $10,000 into Felx and simply reinvested your dividends in 1985, you would have $75 million right now. $75 million. At that point, I do not care. Not even one little bit about the expense ratio. Not when we're talking about that kind of generational wealth. Okay, so now that we've firmly established that we're extremely we're embracing volatility, and we're only investing in stocks, how do we actually find these mythical, high-quality companies? Well, my friend, you literally only need three things, aside from some kind of undeniable economic moat, a competitive advantage that nobody else has. First, consistent net income growth. We want companies that are growing their earnings year after year, like clockwork. Second, share buybacks. This is huge. When a company buys back its own shares, it not only prevents your existing shares from being diluted, but it also pushes the earnings per share up even higher. It is a win, win, and third, high return on invested capital, or return on capital employed. Consistently, if a company isn't getting at least 10% here, don't even bother looking at it. We're in our 20s. We have so much time ahead of us. We need to be investing only in companies that consistently deliver double-digit earnings per share growth every single year. If it is anything less than 10%, seriously, don't even look at it. It is not worth your precious time, of course. There is a lot more that goes into it, and I'll show you how to dig a little deeper in a second. You can use free tools like Seeking Alpha or Yahoo Finance. They're fantastic for research, but I personally use Qualtrim, so I'm going to give you a sneak peek there, but here is the deal. If we've only got, say, 3 shots in the chamber of our financial revolver, we need to be taking the most efficient shots possible at the absolute highest quality companies we can find. And if a company doesn't meet these 3 minimum criteria, we don't even waste a second thinking about it. We move on. So let's take a look at ASML. This is the largest holding in my personal portfolio. It makes up over 15%. And some people might scoff at me for having such a concentrated position. But honestly, I want even more. This company, if we look at their earnings per share, it has been down a little bit recently. But I understand their business model. I've done my homework, so I'm not worried about that short-term blip over the long term. They have been absolutely crushing that 10% standard I set. They've been growing at an insane pace. Really, all you have to look for is over the long run. Is it going up and to the right? And is it doing that at a fairly fast speed? We can see that with their earnings per share. We can see that with their revenue, the top and bottom lines are both moving up quickly. Free cash flow, ideally, especially if you're a dividend investor, you want a lot of free cash flow growth, free cash flow per share, and importantly, more cash than debt. Companies with little to no debt have an extremely hard time going bankrupt. Peter Lynch once famously said that, and he is not wrong, it is incredibly difficult for a company to go belly up if they have no debt. ASML has way more cash than debt, which is a fantastic sign. And if we move down to some of the other stuff I was talking about earlier, they buy back shares. That is also excellent. Why? Well, not only are you not getting diluted, but also since they're actively buying back shares, it pushes their earnings per share up even higher, which is beautiful. Also incredibly important, return on capital employed, or return on invested capital, whatever you want to call it, at least 10%. Ideally more, some of the really top-tier companies can get around 20%. ASML has been sustaining over 30% return on capital employed over the past 4 years. And I would assume even during this year, 2025, that shows a clear, undeniable competitive advantage. It shows they are doing something incredibly well, and that is a really, really good sign. 30% is super high, and I would imagine their return on invested capital is somewhere similar. And aside from all this, margins. Margins are super important. We want at least steady, and ideally growing margins. If we look, their gross margins overall have been pretty steady. Their operating margins have been steady and kind of rising a little bit. I need to zoom out a little bit more on the chart. But their operating margins have been fairly steady and somewhat rising. Profit margins are pretty much the same thing over time. You see, it is slow, but it consistently goes up. You only want to invest in monopolies or companies with wide, deep moats. Again, ideally, we're trying to hold just 1, 2, maybe 3 stocks, not a huge basket. So we want to choose the absolute highest quality companies. And the reason why ASML is such a large holding in my portfolio, aside from the fact that it is just stupid expensive, is because it is the only company in the entire world that does what it does. I literally cannot think of a bigger moat than that. They make these crazy EUV lithography machines. Basically, without them, we wouldn't have Tesla, Nvidia, Intel, Qualcomm, Broadcom, Taiwan, semiconductors, the entire technology space as we know, it would just be completely different. It wouldn't be the same at all. And that, my friends, is why I'm comfortable having it as such a large position, and that is why I want to buy even more. Now, there are tons of other companies like this, maybe not with as wide of a moat as ASML, but let's take MasterCard for example. It shares a duopoly with Visa. They basically own the payment processing world. Amazing numbers. It doesn't grow perfectly every single year. No company really does, but it has really consistent, really rapid growth across the board. Margins are extremely high, little debt, and they have such a massive runway to go. Think about it. They literally make money pretty much every single time someone spends money. That is an incredibly wide moat. They are so deeply entrenched in our financial system. That is a prime example of a high-quality company. I only own a little more than one share, so not a lot, but I heavily plan on buying more of them. I've just had other opportunities I've been spending my money on lately. Now, maybe this concentrated approach is hard to sustain over the long term, which is a valid argument for just dollar cost averaging into the SP, but it is something I truly believe in, and folks like Terry Smith over at Fundsmith have been doing this for years, and he has been absolutely crushing the market, but I don't want you to stop there. So we've gotten our mindset dialed in, we've figured out what we're going to invest in and how we're going to invest. But that is not the end of the story, not by a long shot. Again, we are going for heavy growth with a big risk appetite and a lot of volatility. So where else can you get that crypto? Now, before you click off this video in disgust, hear me out. I've been largely skeptical of crypto for a very long time. I've seen the hype, the scams, the ridiculous coins, but really you only need to invest in Bitcoin. You don't have to allocate a massive part of your portfolio to it, maybe like 10 to 15%. You don't have to go half freaking Bitcoin, half stocks, but it is good to allocate at least some of your portfolio to this. Because at least in the case of Bitcoin, let's really think about this. Right, there are only ever going to be 21 million of them, total. The supply is already capped. So there is pretty much infinite upside, theoretically. And on top of that, it is not directly linked to the stock market, and it is not directly linked to inflation in the same way traditional assets are. Now, maybe I have a little bit of a bias because I've seen a ton of videos about how you just need 0.1 Bitcoin.